My name is Jake. Welcome to the channel. I have a pretty hot take in today's video. I want to talk about mortgage REITs. Some of these mortgage REITs can yield up to 15 or 20%. And I want to share with you in this video what they are and why I don't invest in them. Now, if you do invest into a mortgage REIT, that's okay. That's cool. We can still be friends. But I'm going to share with you why I don't. And if you're new to investing, and you're thinking about building a dividend portfolio and you see that some of these REITs are yielding like 15% and you're like salivating in the mouth, you're drooling all over the place, you're like, oh, dividends. And you might be thinking, oh, dividends, great, good, it only goes up. No, I want to share with you the actual truth of what it's like to invest into a mortgage REIT and some things that you want to look out for, because a lot of videos on YouTube, they pump this idea of high dividend yield, that it's sustainable, and they don't really talk about the risk. Or if they do talk about the risk, it's like a small little disclaimer and they just kind of brush over it. I want to share the reality with you of what it's like to invest into a mortgage REIT and help educate you so that you can make the decision for yourself. So first, let's understand what a mortgage REIT is. When you think about real estate investment trusts or REITs, usually people think about, retail buildings, maybe a CVS, a Home Depot building, a LA Fitness building, an actual physical real, structure. The difference with mortgage REITs is you're not investing into the physical structure, but rather you're investing in the debt, everything that happens behind the scenes to get that building up and running and financed. So you're not investing, you don't have ownership in the building. You're invested in many cases when you invest into a mortgage REIT in a mortgage-backed security and not the actual building itself. Whereas if you were to invest into a real estate investment trust like Realty Income, for example, you're investing in a business that has ownership in the actual building. So for example, when you go to CVS or Walgreens, you walk into that building, most likely that building is actually owned by a REIT, by a real estate investment trust, and that company has ownership over this building. So let's take a look at a few companies that are classified as mortgage REITs. Okay. And if you go over here and you take a look at, you use a website like REITs, for example, you're going to have all of the sector specific REITs that are classified as mortgage REITs listed in this section here that we're looking at right now. And you can see here that the largest one by market cap is NLY, Steward, AG&C. I see AG&C all the time. And can I be honest with you? Can I be really, really straightforward and honest? Before I created this YouTube channel and I was a complete noob, I was investing into AG&C. Because they paid a cool dividend. And I thought that I was a dividend investor because I invested into AG&C. So I want to be very, very clear. At one point in time, I also invested into one of these. And I can say now from personal experience, for me personally, it was a mistake. And I hope that I can help someone out there that's maybe new to investing and is thinking about this. Maybe I can help you not make that same mistake that I made. Okay. And so these are the largest mortgage REITs available here in the US, okay? And you can see, there's a long tail. The majority of them are very, very small. A lot of them are probably going to get acquired or go under. It's really a volatile market, okay, when it comes to mortgage REITs because they're so sensitive to interest rates. Okay, and so this is the thing that really, really gets dividend investors who are new and don't know what they're doing. This is what gets you really excited. A 20% dividend yield? What? I could retire tomorrow. All I have to do is invest $10,000 and I'm getting, no, it doesn't, guys, it doesn't work that way. Okay, so when you're new to investing and you pull up a list like this and you're like, whoa, holy crap, AG&C, almost 15% dividend yield. That's incredible. There's more to it than just this right here. So when you're new to investing, you go and you screen for the dividend yield, it's very easy to get stuck on just one piece of this, okay? And I want to help you kind of look beyond just the dividend yield and help you understand the bigger picture. With some of these mortgage REITs, it's been really hard to watch some of them get cut in half, the share price as well as the dividend yield. And it's hard to see your dividend income go from $100 a month to $50 a month. And it's hard to watch, kind of like this.
Ow! Ow! It's the wax, honey. Relax. Ow! Oh my God, no way. Ow! Oh my God, no. Holy of.
So the first thing that I want to say, whenever you research mortgage REITs, a lot of people and a lot of articles talk about the low volatility of mortgage REITs, that these are great for retirees. And in my opinion, this is the opposite of what a retiree should be investing in, especially if you're an early retiree or if you plan to live for more than the next 10 years. You probably are doing yourself a disservice by investing into mortgage REITs. And so that's kind of a myth, in my opinion, that mortgage REITs are great for retirees, because of what we're going to take a look at next. So let's take the example of ticker symbol ARR, and let's go back and let's take a look at the history. This is pretty simple to do. So if you go back 10 years ago, and this REIT here pays a monthly dividend. A lot of these mortgage REITs, this is how they get you, is they pay a monthly dividend. And so that's kind of like, well, oh, right, they pay a monthly dividend. All right, great. But you're sacrificing a lot of quality for it. Okay. So if you were to go 10 years ago, every month you're getting 64 cents in a distribution, right? Okay. And so now if you fast forward 10 years, you're getting only 8 cents. And so you might be thinking to yourself, if you invested $10,000, or let's say you're a retiree and you invested $100,000 or your life savings, you're getting only a fraction of your original investment, only for the high dividend, because these dividends get cut all the time. And so when you look at that 15 or that 20% starting dividend yield, you can just, with a lot of these, just imagine that within the next couple of years, that 15%, your initial yield on cost is going to be cut in half and more and some. So it's very, very important that you understand that this dividend yield, in many cases, in more cases than not, that it's not sustainable. And a big reason why this is not sustainable is if you go to the financials and you look at their revenue. This is just a simple example, right? If you look at their revenue of this business, this is their revenue over the last 10 years. Do you think that they're able to sustain a growing dividend? No. Do you think that someone who is retired should be investing in this? Absolutely not. So I hate whenever I see, people pumping up or hyping up one of these mortgage REITs, I just kind of shake my head. Man, these people are doing you such a great disservice when you don't really look under the hood and truly understand what does it mean to be getting that 15% starting dividend yield. Okay. And is it really, really sustainable? That's one example. I want to use another example with AG&C here. This is one that people talk about all the time. People love this stock. And this is the one that I invested in, I think it was like 5 or 6 years ago. And, just let's look, 5 years ago, if I would have invested, I think I invested right around the $17, $18 price per share. It's been cut in half. But you might be thinking, well, the dividend. Okay, well, let's take a look at what's happened with the dividend. Let's say 5 years ago, I was getting a monthly dividend of 18 cents. That's awesome. That's so cool. But what's happening now? Well, right now, I'm only getting a dividend of 12 cents per month. So my dividend income has been slashed. But here's the scary thing. Imagine you're retired and you no longer are funding your portfolio. You're no longer able to reinvest the dividends. Your income has been great. Just your income is getting destroyed. And that's why for retirees or early retirees, this is not what you want to look for. Okay. The high dividend yields, it's not worth it. It just really isn't. And if we go and we look at the financials here, when looking at AG&C, and the reason why they're cutting their dividend is because their revenues are sporadic, as well as I'm sure their net income, for example, is greatly sporadic as well, right? So and mortgage REITs, and REITs in general, you value them a little bit differently. So that's the example with AG&C. Let's take a look at another one. Let's take a look at NLY. This is the largest mortgage REIT by market cap. Over the last 10 years, the share price has only been going in the wrong direction. Let's look at the dividend history. The dividend history of NLY, they pay quarterly, so not monthly, quarterly, over the last 10 years, right? Like, If you're retired and you want to live off of your dividend income, this is an absolute nightmare. Okay. And so this is why I put in the title of this video, why I don't invest in them, is because I'm not really planning on making a lot more money like I did before when I was working my full-time job, and I'm not reinvesting the dividends. So I need to rely on the organic growth of the business to outpace inflation to keep paying me more as my living expenses go up. Now, I do want to show one that is doing pretty well, that has a pretty good track record, that kind of stands out from the rest. I didn't want to cherry pick the worst and not show one of the ones that is actually doing things pretty well. So if you look at Arbor Realty ABR, this is a mortgage REIT as well. It pays a quarterly dividend. Their dividend, they've done fairly well. Now, with the financial crisis, they kind of get a pass with me. All REITs and mortgage REITs, they got destroyed during the financial crisis. But since then, they've been fairly consistent. So this is one where I'm like, okay, this one could maybe make sense. Okay. But it's one of the very, very few. When you look at that list, there was like 20 of them on there, and where only one of them or something is doing well. It begs the question, well, what's going on with this entire sector? There's a lot of bad apples, but with this one, looking at with Arbor Realty's revenues, they've done well. They've done better. And when it comes to mortgage REITs, I am more of the mindset of show me before you tell me. Show me your results. Show me and prove to me as an investor that you're consistent before I would ever consider investing into an individual stock, let alone a mortgage REIT. So if you were to stack rank these mortgage REITs together, and if you were to look at the total return, that's the dividend with the capital appreciation, right? So we saw with AG&C how the share price had got cut in half, but you're like, well, I'm still getting the dividend. Well, yeah, you are. But when you look at the dividend plus the capital appreciation, AG&C over the last 10 years has performed very, very poorly, right? And you got some that are even actually in the negative over the last 10 years, but they're still paying their monthly and quarterly dividend. And, that's just the scary thing behind this. If you're looking to live off of your portfolio, if you're investing heavily into these type of investments, it's in my opinion, it's not the wisest thing to do, because you don't want to take the risk. You want the consistency. You want true consistency, and not, something that's portrayed as conservative, monthly income, but in reality, you're being robbed of your return, your total return, every single year. So that's just kind of my take on it. If you just compare it to a simple dividend ETF like SEHD, SEHD has been also very, very consistent, not volatile, but you're getting in a much higher rate of return over an extended period of time. Now, for example, if you're in your maybe late 60s, I could see the appeal to invest into one of these where it has a higher starting yield. Just bear in mind that yield is in most cases not going to be sustainable. The next part that I want to share with you is the main reason why I don't invest into mortgage REITs. And the main reason is the concept of yield on cost. Your yield on cost with mortgage REITs in most cases is working against you. Okay. Now, if you didn't understand what I just said, it's very good that you're watching this video, because this will help you. When it comes to yield on cost, this is the yield that you're getting on your initial investment. And we invest for the long term. If you're in your 20s, 30s, 40s, and you have a couple of decades before retirement, yield on cost is everything. Okay. Your yield on cost is your initial investment. Let's say, for example, 10 years ago, I invested $1,000. Well, $1,000, that investment of $1,000 10 years ago had a specific yield. And the question is, did that yield grow or did it not grow? And I want to share an example with AG&C. With AG&C, if you look at the yield on cost, this is what is scary about these REITs. Your initial yield on cost, if I, for example, hypothetically would have bought AG&C 10 years ago, my initial yield on cost would be $4.45. But here's the thing. This yield 10 years ago likely would have been in the 10 to 15% range. But because the yield has been cut over the last 10 years, and because it's not grown, my initial yield on cost is lower today than it was 10 years ago. So when you look at this, when you look at a company, you look at any ETF or any individual stock or whatever, and you look at yield on cost. This is under the dividend section, under dividend yield. Go under here under yield on cost. And if this orange line is going down, the further it goes, so if it's going downwards, backwards, that is a massive red flag. So right now you can see, oh, well, Jake, you're getting a 9 or 10, or I think it's like 15 actually, 15% yield right now. Well, in 10 years, it's probably, I don't have a crystal ball, but it's probably going to look a little like this. So your investment today, which is yielding 15%, in many cases, and would be reasonable to assume that in 10 years, that 15% yield on cost is probably going to be more closer to 5%. Okay. Now, this is why I love investing into businesses that are growing. They're growing their earnings per share. They're growing their revenue, and they're rewarding shareholders with a growing dividend. This is why I named my channel Dividend Growth Investing, because it's all about the growth, the long-term perspective of that's why we invest. Let's compare that with realty income. This is a regular REIT that owns buildings like CVS and Walgreens. If we go down and we look at the yield on cost over the last 10 years, if I would have invested $1,000 10 years ago, today my initial yield on cost would be just under 8%. 8%. Today, the initial yield on cost is right around 5%. Now, in 10 years, it's very, very possible that my initial yield on cost of 5%, right? In 10 years, it's possible that it's 8, 7, 9, whatever percent. But it's very, very likely, assuming that they're continuing to grow their business and to grow their cash flows, that the yield on cost will continue to grow. So the major takeaway here is mortgage REITs, they destroy your yield on cost. With regular growing businesses, like a realty income, like a PepsiCo, like a waste management, your yield on cost is going to grow. And as a long-term investor who is planning on retiring off of his or her dividend portfolio, this is absolutely paramount. So important that you understand this. And if that wasn't enough, let's take a look at the tax shenanigans of these mortgage REITs. Now, this can be the case with regular REITs as well, so don't just single out mortgage REITs. But if you look at the 2022 filing of the 1099 dividend form from AG&C, what you will notice is in 2022, if you would have held, for every share of stock that you held, you would have gotten $1.44 in dividend income, in income, right? A distribution. Now, part of that income would have been taxed as regular, ordinary income. But here's the thing. Another portion, about a little more than half of it, would have been constituted or reported as a non-dividend distribution. Do you know what this is? A non-dividend distribution? This is return of capital. Do you know what return of capital is? Return of capital reduces your initial price of the stock that you own. So every year you're getting money, your initial investment returned to you in the form of a dividend. Now, a lot of REITs do this, and that's fine, but it's important that you understand that this dividend, it's not really from, it's not because the business is growing, they're returning part of your investment back to you. And if you were to say, for example, you bought AG&C at $10 and you had, let's say, $1 of return of capital, well, your cost basis is no longer $10, but it's $9. And so if you were to sell AG&C in the future, your cost basis is lower, so you're actually going to be paying more in taxes when you sell it. When and if you sell it. So it's important that you understand the shenanigans that goes along with these mortgage REITs as well as REITs in general. And it's important you understand that this dividend yield, this 15, 20% high, massive dividend yield, there's more to it than meets the eye. It's really important that you understand how to invest based off of your time horizon. I use the example of AG&C and Realty Income. Someone that's in there who's maybe in their late 60s is going to invest very differently than somebody that's maybe in their early 30s. And it's important that you understand that. I talk a lot about this on my channel, and if you don't understand this concept of how to invest based off of your investing time horizon, I made an entire video on this topic, and I'd highly recommend you check it out because it really will open your eyes to how you should be investing if you hope to one day live off of your dividend portfolio in the future. Thanks for watching, everybody. I hope that the video was helpful.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.